What's up guys, my name's Curtis and welcome to 5 Minute Finance, where I take personal finance topics and explain them to you in 5 minutes or less. I talk about it all the time, but the best way to make money long term in the stock market is through steady, consistent investing each and every month. The reason for this is the idea of what's called dollar cost averaging. As you'll see, it not only helps smooth out the volatility in the market, it's also one of the best ways to create long-term wealth. And stick around to the end of the video because I have a couple examples that really show just how powerful this method is. In a nutshell, dollar cost averaging is when, instead of investing all of your money in one lump sum all at one time, you invest the total amount across periodic purchases in which you buy the asset regardless of price, and you do this at regular intervals. Over time, this averages out all the fluctuations in the price of the assets that you will be investing in. So you could invest weekly, monthly, or simply every single time you get a paycheck. As long as you are consistently investing at every single periodic interval, you would be using the dollar cost averaging method. One of the most common ways that this strategy would be deployed is in a 401k plan, where every single paycheck, your company is automatically taking a chunk out of your paycheck and investing that in the assets that you choose. There are two main reasons that I really like this method. The first is that most people don't have large sums of money just laying around, so they can't invest thousands of dollars all at once in the market. Using this method, you can build great wealth with relatively small amounts of money invested every single month. Second, it can really help smooth out market volatility. If you're automatically investing in the market regardless of its current price, then sometimes you're going to buy when it's up and other times you'll buy when it's down. And this really helps even out all of the fluctuations that the stock market sees. The first example of using this method, I actually didn't believe the numbers when I first saw them, but it's a great depiction of how dollar cost averaging is really beneficial. The Great Depression was without a doubt the worst financial time period that this nation has ever seen. But what if we consistently invested in the market during that time? The S&P 500 hit a high of $477.27 in August of 1929. The market then crashed and it didn't set a new record until December of 1958. That's 29 years. But let's assume somebody invested $100 every single month starting in August of 1929. Right before the Great Depression hit. After 29 years, when the market finally made a full recovery, believe it or not, their account balance would be worth almost $350,000, and the amount they put in would only be around $35,000. Even more shocking than those raw account values, because again, I just kind of chose an arbitrary $100, is the average annual return during that time, which is 13.07%. This means if you started investing the day before the worst financial time in this nation's history, over the course of the next 29 years, you would have seen an average annual rate of return of just over 13%. That is truly astonishing. But that return is only possible if the investor took all of their emotion out of investing and put money in every single month, regardless of the market price. Now, I do realize times like the Great Depression, the 2008 housing market crash, or even this 2020 market crash causes a lot of unemployment, and there's a lot of people that don't have any money to invest whatsoever. But I wanted to show that example to depict how seemingly bad times financially can actually be some of the best chances for you to invest. And it's always best to separate investments from your emotional reaction to the current market situation. I do have another example, and I made an entire video on it. I'll link it down in the description. But it shows that using the boring, consistent approach of the dollar cost averaging method, you're actually much better off long term than if you tried really hard to time the market and invest whenever the market crashed. The saying that time in the market beats timing the market is just about always true. Again, for a more comprehensive look at that example, I'll link the video down in the description. I hope this video helped you guys understand the power of dollar cost averaging, and there's actually a very good chance you're already using this method in your 401k account if you have one. If you guys enjoyed the video, a thumbs up would really help me out, and if you're new around here, consider subscribing for more finance videos in the future.